Welcome back friends to the class number 58. In the previous video, we have discussed the concept of DSCR. We have discussed how DSCR is practically calculated. I am not over yet with the topic of DSCR since I want to explain the concept of income, the cash profits, the cash accruals in full-fledged in-depth details to you, right? So these will be covered in the upcoming videos. Meanwhile, we will discuss what are the shortcomings or drawbacks of the DSCR that we calculate. So, number one drawback or limitation of DSCR is that it is based on purely past data, while the loan repayment or the business performance will come in the future. When we calculate the DSCR, we trust the past year profits. We assume that the client or the entity shall keep on running like this and shall keep on earning these much of profits in the future years as well. But friends, as you know, future is uncertain. The loan which we are giving today will be repaid based on the future income, right? So we cannot ascertain or we cannot be sure of the fact that the entity will continue to earn the same level of profits in the future as well. So this is the shortcoming of DSCR basically, which cannot tell the future to us, right? But alternatively speaking, there is no other option to us also, right? So there is no other option that I can tell you that you can use this method instead of DSCR to calculate the future earning. Future is always uncertain, right? So this shortcoming will always remain irrespective of the fact that which ratio we are calculating. Another shortcoming that I have noticed in DSCR is the ignorance of other fixed nature expenses. When we calculate DSCR, we want to compare the profits earned by the entities to the fixed obligation that it has, right? But there are some other fixed obligations. For example, rent. Rent is also a kind of fixed obligation of the entity. So DSCR calculations doesn't take into account any repayments, any future obligations of rental expenses of the entity, right? Like rent, there can be other expenses also which are fixed in nature. So ideally, DSCR's base should be broadened by the accounting board or the local bank levels. So it should include all the fixed obligations of the entity. The third and the most important limitation of DSCR is that income that we are taking for calculation of DSCR, we are saying that this is the cash income, this is the cash generation, is the business, but that may not be true. The cash profits may actually be totally different. Why? For example, client is doing sales of rupees 100, client is doing purchase of rupees 80, and suppose these are total net profits of your 20 and there are no other income or expenses. So since there are no extraordinary income, expenses or non-cash income or expenses, you will say, sir, these 20 rupees represents the cash operating profit of the business. But what if I tell you that all of these sales and purchases are practically done on credit only? There is no cash received on sales, no payments received from the debtors, and no payments are made to the creditors. So how can these 20 rupees be the actual cash profits? So this is the limitation that the DSCR has. It doesn't take into account the actual cash generation from the operations. There is one solution to it. We prepare cash flow statement and we take cash from operating activities. We check the bank statement, we check the cash flows of the business. But these are the subsidiary options, alternative options. In modern time, cash flow statements is considered as the most accurate, financial statement that reflects us the cash generation from the business, but not the DSCR, not the profit and loss account. DSCR totally ignores the future incomes. If client is taking machinery term loan at present, of course, by buying machinery or by adding additional factory, his future sales, his future profits with economies of scales will increase, right? But DSCR is based on purely past data and future income is not considered in DSCR calculation. And I can also say, even if we consider the future income, it is very difficult to be sure. It is very difficult to be sure of what would be the actual future income. The results may get inaccurate if we take too much high future income. If we consider too much high future income, we go very aggressive and consider client's sale as 2x, 3x from present levels and consider his profits as 2x or 3x of current levels, we can be very aggressive in our calculation of future incomes. There is a lot of biasness involved in it. So that is why I am saying that the difficulty to assess future income is also a kind of drawback that we can see in calculation of DSCR. Another disadvantage of DSCR is that it covers only the debts that as it is they are appearing in the balance sheet. The debts that appearing on the balance sheet are only covered in the DSCR calculation, and the debts which are off balance sheet, contingent liabilities or future contract obligations, or even the personal debts of the promoters, if the promoters do not have any other income other than from the entity itself, then their personal debt is kind of also repaid from the profits of the entity only, directly or indirectly. So, but the DSCR does not cover up, it does not consider the debts which are off balance sheet. Another point is it gets difficult to calculate DSCR when there is balloon repayment or step-up repayment method is followed in term loan repayment. In DSCR calculation, in obligation side, we take the monthly obligation or future probable obligation of principal and interest. In step-up repayment method, the client's EMI steps keeps on increasing year on year basis, right? While in ballooning method, the client has to pay a bullet amount, a big amount of payment at the end of the loan tenure. But it is very difficult to plot the obligations in DSCR when the client's repayment schedule is based on balloon repayment or step-up repayment. If the interest is capitalized, then it may get ignored in DSCR. You know very well that if the building is under construction, if new project is taking place, and the client has taken the loan from the bank to finance that project, so the interest amount till that project has started its operation, the interest amount is added to the cost of the asset. Then it gets reflected in the balance sheet itself, added to the fixed assets. It doesn't get debited in the profit and loss account. If it doesn't get debited in the profit and loss account, your EBITDA calculations may go wrong. Your calculations of obligations may go wrong. Of course, you can correct this if you know the actual capitalization amount, if you take the actual debt, if you are very, if you are very open up in your mind, if you are considering the whole proposal on 360-degree basis, then you can cover this mistake. But many people may get ignored, may lapse in calculation of accurate interest obligations in this scenario. Then another disadvantage of DSCR that I see is the varied calculations method. Some banks are taking pre-tax profits, some banks are taking post-tax profits, some banks are adding non-operating incomes, some banks are not counting a particular income or expense as non-operating income or expense. So there is a lot of biasness or judgmental thing involved here. There is no standard practice as to what to include or what to not to include, right? So this biasness may give different results, and depending upon the bank, the DSCR can result in a different figure, so which can impact ultimately your final loan decisions, right? So this was the main drawbacks or limitations of DSCR. I want to know your opinion on the comment box. What do you think is the main drawback of DSCR according to you? Please suggest me in the comment box. I will wait for you. Thank you very much.